When you look at the raw data of a violently swinging stock chart, traditional investing demands two difficult things from you. First, you need significant upfront capital to participate. Second, you need the stomach to absorb massive financial hits if the market suddenly crashes. But imagine a scenario where you could control a massive block of a company's shares while paying only a tiny fraction of what those shares actually cost on the open market. Or imagine you could purchase a specific insurance policy that protects your existing portfolio if the market suddenly tanks. Financial instruments known as options provide this specific structure. While they were once restricted to institutional veterans with significant capital, they are now accessible to traders at every level. To understand how they work, we look at the core mechanics shown on this scale. An option is simply a contract. The buyer pays for the absolute right to make a transaction, while carrying zero obligation to actually go through with it. To see how this asymmetric balance works in practice, let's step away from the stock market. Let's say you want to buy an apartment in a growing neighborhood for 1 crore rupees, but you don't currently have the total funds. Pay a 1 lakh rupee fee, locking a 1 crore rupee purchase price for 6 months. If value climbs to 1.10 crore rupees, exercise your right for a 9 lakh rupee profit. If value drops to 90 lakh rupees, walk away, capping losses at the 1 lakh rupee fee. This structure strictly caps your maximum possible downside to that initial upfront fee, while leaving your potential upside open to whatever the market delivers. That same real estate logic applies directly to buying shares of a publicly traded company, like the conglomerate ITC. We map our apartment contract directly to the 4 variables of a stock option. The shares act as our underlying asset. The locked-in target is the strike price. The timeline is the expiration date, and the upfront fee is the premium. There are 2 flavors of these contracts. On the left is a call option, purchased when predicting the asset's price will rise above your strike price. Conversely, you purchase a put option when predicting the asset's price will fall below the strike price. But for every buyer securing a right, there must be someone on the other side of the deal. These are the option sellers or writers. They collect your upfront premium, and in exchange, they accept the legally binding obligation to fulfill the trade if you choose to exercise your contract. It is a closed ecosystem. Risk and reward are constantly traded back and forth between buyers and sellers, driven by opposing predictions of the future. There is one final dimension that governs every option contract: time. Unlike simply holding a stock, an option is a decaying asset. It is tied to a strict countdown. The American style offers maximum flexibility. The buyer can exercise their right any time before the expiration clock runs out. In contrast, the European style is rigid. It restricts the buyer to exercising their right only on the exact final day. Despite the geographic names, these terms simply define the rule sets. In the Indian market, for example, all equities and index options follow that rigid European style, with contracts systematically expiring on specific Thursdays. These 4 core components — asset, the locked strike price, the set expiration date, and the upfront premium — transform an abstract market prediction into a rigid legal framework. By defining these terms up front, a trader replaces the open-ended risk of stock ownership with a clearly defined set of boundaries. Whether a market is booming, crashing, or trading sideways, these contracts allow you to tailor a position to a specific risk tolerance. Mastering these tools means you can leverage your capital and enforce downside protection, completely regardless of the market.